Well, hello there. My name is P.R. Basker, and I am an ex-international banker. And today, I wish to spend some time reflecting on things um that ail the economy, in banking in particular. Uh, the way I see it, that in the last 2 decades, let's say roughly from the 90s onwards, and if not in through part of the 80s, banking has morphed, and its morphing has been more and more as the years roll by, both in 1990s and then again now in the decade that just gone by, and and it's time that we did some reflecting. The most important thing that comes to my mind is that the banks have somewhere along the line forgotten that they are fiduciary institutions. A. Number two, that the money that they pick up is basically from you and me, that is, by way of deposits. And and it's that money which they have picked up from you that they, well, lend to others or invest perhaps and make the profit margin in the process. So there is definitely a spread, as one can visualize. I mean, after all, banks are in the business of making some money. So, to, so they pay you pay at a certain rate of interest as far as your deposits are concerned, depending on the nature of the deposits, whether they are, you know, for a term or whether they are deposits that can be withdrawn any moment, like the savings or the checking accounts. But in the final analysis, they do compensate you. And on the other hand, when they lend out that money, either as working capital or as a personal overdraft, or even for mortgage loans or for more long-term loans as such, they lend out with different rates of interest. The issue that arises is uh, what should be the roughly the standard spread, if you if we may so call it, and like what is an acceptable kind of spread that does not verge or does not transgress both the fiduciary responsibility of not playing with other people's money and undue risk taking, and at the same time compensates depositors in a reasonable manner and to a reasonable extent, and at the same time it also serves uh, the banks and their investors and their stockholders or whatever, their interests too, by giving them a certain rate of return. So definitely they got to have some kind of a differential between the rate at which they pay customers for their deposits and the rate at which the rate they charge from borrowers. So the question that arises is how much is okay and how much is not okay, and that's where the whole thing rests. What we have noticed in the recent past is, whatever may be the background considerations and strategies and goals and what have you, which will be part of a separate discussion altogether. It's seen that over the course of at least in the last 2.5 decades, that there's a kind of reduction in compensation as far as depositors are concerned. And on the other hand, on the other side of the equation, higher rates of interest on lendings. And when we say lendings, we don't necessarily mean lendings for purchase of a home or consumer loans or small business finance. We also mean credit cards. So when the spreads are so large, where the average rate that's paid on various types of deposits and the rate, average rate that's charged on both short-term and medium-term or long-term lendings by banks, there has to be some semblance of reasonableness about it. Because if that is not ensured, then what's likely to happen is that the banks are entering the territory of what we know as usurious lending or usury. Remember that banks came into existence to replace the usurer or the money lender. So they are still money lenders. But the difference between them and the usurers of pre-banking days, when I say bank, I mean in the form of a structure called a bank, despite the fact that they are in money lending business. The banks are separate from a private money lender, for instance, who gives you a private loan and may charge any amount that he pleases. It could go to 20%, it could go to 30%, or even 40% in some cases. So the issue that arises, what is reasonable and what is not? I think what's important here is that when a customer keeps money with a bank, he does it for various reasons. One of them is fundamental, that is security or safety of the funds. And then he weighs it with other options like the stock market or whatever and then balances out his own perception of risk, and then takes a conscious decision to put money in a bank in a certain form, like either leave it in checking accounts or leave it in say savings account, or even in certificates of deposit, or in some nations is known as term deposits or reinvestment term deposits, or whatever you have, which are nothing but deposits which are kept for a certain period of duration, and you need to keep them for that duration, so that and if you encash them before that, you're likely to pay a kind of penalty for doing so. So the basic purpose, the basic approach of the customer vis-a-vis the bank as compared to other investment options like the commodity markets or the stock market, or even for that matter real estate, which is itself fixed investment and not easily encashable, or even metals like gold and silver, which again fluctuate within a range, but they're not easily liquid. You cannot cash them easily. You cannot turn them into cash easily. So therefore, basically a person leaves money in a bank because of the liquidity of that investment and a reasonable rate of return and the security of the funds, and in many cases the assurance that it is also protected by government insurance or even private insurance, um, to the extent of any loss occurring by way of bank going into liquidation, and you still get some compensation. And so therefore, these are the factors that generally that the customer um, considers when he leaves money with a bank. The flip side of it is the bank wants to make the maximum out of that money by lending it to others and making profit on it, or even investing it somewhere. Now that itself is not a problem. The problem is where the banks have started taking undue risks, using this money recklessly. In other words, the safety and the security that the customer expects or envisages from the banking institution is not is kept. I mean, it's like it's on paper. It's still acknowledged by the banks, but when it comes to practice, no, it's not happening. Not now. So they are actually playing with people's money, and not just playing with people's money. They're lending at high rates, and again making risk investments. And then, of course, we have the whole business of derivatives, which per se by definition are valid and legal instruments. But the main problem is that they have to be conducted in a prudent manner. So, summing it up, I would say that banks are failing on a couple of counts: fiduciary responsibility, and that is fundamental, and also in protecting the interests of the depositors, while at the same time using money intelligently so that they make some money in the process and share it with their investors, their stockholders, and whatever. And they also ensure that they have sufficient capital and reserves, that they don't easily go into liquidation or bankruptcy, and that they can survive in times of, say, a recessionary trend in the banking industry, or in reduction of the spreads, or maybe when the interest rates are under pressure. But what really of concern is in this particular presentation is the usurious approach of the banks. The fact that they have thrown the winds any concept called reasonableness when it comes to the rate of interest that they charge on lending. And that includes credit cards. But credit cards are one part of it, and they are the most popularly known. But you take an average, when you take a housing loan in, say, in the United States, at a commercial rate, you might land up paying something like 8 to 9%, or even at the minimum 6% or 7%. But what are you getting on your deposit? Even if it's a certificate of deposit, 1, 1.5, 0.75, 0.5. If you go to other countries which are somewhat more inflationary and therefore show higher interest rates regimes, let's say India, for example, where the rates are in a higher range, so you will be getting a return on as far as the depositor is concerned, on savings or fixed deposits ranging from something like 3 or 3.5 or even 2.5 or at best 4% to 10. But when he goes to borrow money, we can be charged anything between 12 and 18% at the minimum. And this is excluding the credit cards, of course. So I think that the banking managements, the bankers associations, they need to reflect on this and see that if economies have to survive and the banks have to have long-term futures, and we have had long-term futures for banks, and they're not institutions created by fly-by-night operators, then it's very, very important that on all these aspects that I mentioned, fiduciary responsibility, on leveraging, on risk taking, on interest rates, and um, in general, uh, both keeping the depositors' interest in mind as well as the the interests of the stockholders in mind. This is what needs tremendous amount of reflection. And if prudence and fiduciary responsibility, if these are thrown to the winds, then I'm afraid that as time goes by, no one will believe, even in banking industry, as they have done so far, as compared to, say, stock markets which are volatile or commodities markets which are, perhaps even on occasion manipulated. So, so I would say, as next banker, to the bankers who are in charge today, go look at the mirror, take a review. And I'm sure once you do that, a lot of the problems in the banking industry and the customers of that industry, both borrowers as well as depositors, they will benefit. And and that's what I wanted to share today. There will be more to come on issues relating to other aspects of banking, but I thought I would end this presentation on this note. I don't think anything is lost forever. It just needs a little bit of consolidation and a little bit of less myopia and getting back the core values and recovery of vision, which is not just short term, but also medium term and long term. Thank you. And well, I'll be seeing you again. My name is P.R. Bhaskar, and I am right now a citizen of the United States, but of India origin. And I live in Louisville, Kentucky. I've been here for about 11 years now. So we'll be in touch. And all the best to the bankers, to the depositors, and to the borrowers. Bye-bye now. See ya.